Control of cash. Cash is one of the easiest assets to hide or move, to be misplaced or stolen. So, internal controls protect cash and they have to meet three guidelines. First, handling cash is separate from record keeping of cash. We've already talked about that. Second, cash receipts, so that means cash that's received, are promptly deposited in a bank. And cash payments are made by check or EFT. So that means electronic funds transfer, so essentially bank transfer. So those are the three things that are in place. One, separation of duties between handling cash and record keeping of cash. Two, any cash received has to be deposited in the bank as quickly as possible. And three, payments of cash, so instead of paying in actual cash, they need to be paid by something that you can track, so either a check or a bank transfer. Cash, cash equivalents, and liquidity. So you know what cash is. We'll discuss what liquidity means and some assets that are considered cash equivalents. So liquidity refers to a company's ability to pay for its current liabilities. So a company wants to have its assets liquid, meaning that they can be used to pay their bills. So cash and similar assets are called liquid assets because they can be readily used to pay for liabilities. A company needs liquid assets to effectively operate. So that's liquidity. Cash, you know what cash is, but it can also include, in addition to like dollar bills and coins, it also includes deposit in bank accounts. So the cash in the bank, your bank account, that's also considered cash. Cash also includes items that can be deposited in these accounts, such as customer checks, cashier's checks, certified checks, or money orders. So that's all cash. Then cash equivalents are short-term, highly liquid investment assets that meet two criteria. First, they have to be readily convertible to a known amount of cash. And two, they have to be close enough to their due date so that their market value will not change very much. So only investments with these within 3 months of their due date usually meet these criteria. Cash equivalents are short-term investments such as U.S. Treasury bills. Cash management is very important. One main reason that companies fail is their inability to manage cash. So they don't know how to manage their cash inflows and outflows so that they are able to pay their bills on time. So companies must plan both cash receipts, meaning receiving cash, and cash payments. So the goals of cash management are, first of all, to plan cash receipts to meet cash payments when due, meaning that they want to make sure that they receive enough cash from their customers on time to be able to make their payments when they're due. And then second goal is to keep a minimum level of cash necessary to operate. So they want to make sure that they have enough in their bank account to be able to cover operations. So within a company or an organization, someone called a treasurer is responsible for cash management. So effective cash management involves applying the following strategies. First of all, you want to encourage the collection of receivables. So the more quickly customers pay the company, the more quickly the company can use the money. Some companies offer discounts for payments received early, and we've talked about that in a previous chapter. The next thing is to delay payment of liabilities. So the later you can wait to pay a bill with it still being considered on time, that gives you more time to use cash that you have. So the more delayed a company is in paying others, the more time it has to use the money before it's used to pay. So companies regularly wait to pay their bills until the last day possible. This is typical unless you are trying to get a discount, if your cash flow allows you to do that and to pay early. Next, keep only necessary assets. So An example of this is inventory. You don't want to tie up all your money in inventory if it's not being sold quickly enough. Acquiring expensive and rarely used assets can cause cash shortages. Some companies lease warehouse space or rent equipment as needed instead of buying. So that's another example. Next, plan expenditures. Companies must look at seasonal and business cycles to plan expenditures when money is available. You want to plan ahead, make sure that you're going to have the cash in hand that you need to be able to pay your expenditures. And finally, invest excess cash. So if the company has like a nice savings account, it could sit there in a regular savings account and earn basically no interest. Or they could invest that cash. So this could either be short-term investments where they earn more interest, or they could use that money to purchase productive assets, things that will help them to earn additional revenue instead of the money just sitting there. Control of cash receipts. This is one specific type of control over cash. So over-the-counter cash receipts. This is basically, at the cash register, you're paying at the counter. That's why it's called over-the-counter cash receipts. So these should be recorded on a cash register after each sale. Customers should get a receipt. Cash registers provide a permanent, locked-in record of each transaction. So it records the transactions, and it's linked to the accounting system. These are the ones that bigger companies are able to have. So less advanced registers record each transaction on a paper tape or electronic file locked inside the register. You don't see those as much anymore. Those are usually just at like the very small businesses. Point of sale systems have become advanced and also affordable enough for most retail establishments to be able to have. And then, of course, we have different apps and things that allow us to pay with cards instead of cash. Because cash, again, is one of the easiest assets to embezzle, to lose. Whereas if you have an electronic record of it, or if it is paid for electronically, that reduces the risk of losing cash. Custody over cash, so that means handling of the cash, should be separate from record keeping. This is about the, 10th time I've said that in these lectures. So this is one thing that should really stick for you. The person who handles the cash or has custody of the cash should not also be the person recording the cash. The clerk or the cashier who has access to cash in the register should not have access to its record. At the end of the cashier's work period, the cashier should count the cash in the register, record the amount, and turn over the cash and a record of its amount to the company cashier. So if you think about this in terms of like a retail store, if you've worked as a cashier, at the end of your shift, you have to count your drawer, and usually your supervisor is there to count it with you as well. So that is just comparing what the cash register says you should have to what's actually in your cash drawer. So the cashier has access to the cash, but should not have access to the accounting records. A third employee, often a supervisor, compares the record, which is what the cash register says you should have, your transactions. So they compare that with the cash receipts reported by the cashier. So what you say you have in your register. Then that record is the basis for a journal entry to record the cash receipts. So then the third employee has access to the records for cash, but not the actual cash. And they are the one who is able to record that based on what the register says, the cash that's actually in the register till, and then the supervisor who has compared those to make sure they're accurate. So there can't be a mistake or cash diverted or stolen without the difference being revealed, because you'll see what the cash register says you're supposed to have and then what's actually in your cash register. Cash over and short. Again, if you have worked any type of fast food, retail, whatever, where you have worked with a cash register, you know that sometimes there will be an over or short. So sometimes errors in making change are discovered from differences between the cash in a cash register and the record of the amount of cash receipts, according to the cash register. One or more customers can be given too much or too little change. This means that at the end of a work period, the cash in the cash register might not equal the record of the cash receipts. This difference is reported in the cash over and short account. Also can be called cash short and over. Means the same thing. It's an income statement account, so it's essentially considered an expense if you're short some, and then it's just considered other income if you accidentally collect some extra pennies from a customer. So here's a quick example of a journal entry for if your cash register has too much cash in it at the end of your shift. So if a cash register's record shows $550, but then you count the register and there's actually $555 of cash, then you would record this overage with this journal entry. So you record the full amount of cash that's actually in the register, $555 as a debit to cash. You only actually sold $550 worth of merchandise, so your sales revenue is only $550. So that difference of the $5 is credited to the cash over and short account, because remember, your debits have to equal your credits. So that $5 has got to go somewhere and it's got to balance the transaction. So that's when you have too much cash. When your register is short, meaning that you don't have as much cash as you're supposed to, then we'll give the example of if the cash register's record shows $625, that's what you're supposed to have, but the count of the cash in the register is only $621, you make a similar journal entry, same basic structure. You debit cash for the amount that's actually in the register, which is $621, and you credit revenue or sales for the amount that was supposed to be, which is $625. There's a difference of $4. You're short $4. You have to make sure that your debits equal your credits, so you can already tell that you need an additional debit, and you will debit cash over and short for the $4. So that's at a cash register. So there are other companies where you will receive payments by mail. So if someone sends you a check in the mail to pay for a product or service, that would be cash received by mail. So there are rules for cash receipts by mail. 2 people are assigned to the task of opening the mail. So this would mean that, if it was one person opening the mail, they could kind of skim some of whatever comes in through the mail. But if 2 people are assigned the task of opening the mail, theft of cash receipts by mail would require collusion between the 2 employees for theft to happen. And that's less likely to occur because surely one of those 2 people has some sort of honesty and ethics, right? So what is supposed to happen is that the person opening the mail enters a list of the money received. So on this list, they'll have the sender's name, the amount, and an explanation of why the money was sent. So to pay on account number, whatever. So the first copy of that will be sent with the actual money to the cashier. A second copy of that list will be sent to the record keeper, so the accounting record keeper. And then the third copy is kept by the person who opened the mail. So there's 3 copies of that list that the person opening the mail created. So they keep 1 copy of it for their records. A copy of it goes with the actual money that was received, and another copy goes to the person who enters the amount in the records. So this process is a good internal control because the bank's record of cash deposited has to agree with the records from each of those 3. So everything has to match, and then you make sure that the bank deposit matches that amount. So if the mail person doesn't report all the receipts correctly, customers will question their account balances. So that's a check there. If the cashier doesn't deposit all of the money, then the bank balance won't agree with the record keeper's cash balance. And then if it's the record keeper who tries to access the cash, they can't because they don't have access to both the records and the cash. So they don't have the opportunity to steal it. So this system makes errors and fraud highly unlikely. You can never completely eliminate the risk of fraud. It's always going to be there because of the human element of it. So the exception would be employee collusion.